Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. My co-host, Simon Podger, is Director of Lending for our sister company, Your Future Strategy. The Buy-In podcast has been a long time in the making for us, and I'm excited to be bringing our passion for property to you. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. So today we're talking about what is the property clock and how does it work. Essentially, the property clock is a tool that's used to measure the cycles of the property market. Like any investment class, property moves in stages. It moves in cycles, and essentially we use the property clock to give us an understanding of where a particular property or region, in particular, is at a stage in the property cycle. So, if you can visualize and picture essentially an old clock face, 12 o'clock being the peak of the market, 3 o'clock being in the declining market, 6 o'clock being the bottom of the market, and 9 o'clock the rising market. Essentially, that's the way major regions are measured around Australia as to where they're at in each stage of the property cycle. So, for example, as we sit here today, a market like Brisbane is approaching the peak of the market, whereas a market like Melbourne is in a declining market. So what is happening in those two markets? What's different about those two markets? Well, primarily there's a lot of fundamentals that drive essentially where a region is in the property market. So let's take Brisbane, for example, right now, approaching the peak of the market. There's a lot of activity going on in the Brisbane market, obviously fueled off the back of the Brisbane Olympics, but there's a lot of investment, sales going into that market. There's population growth going into that market, which is also driving sales and pushing prices up. But one of the key drivers is supply and demand. Right now, currently in Brisbane, we are sitting with a housing shortage. We're not producing enough homes to meet the demand of the market. So essentially, right now, supply and demand is out of kilter, which is also driving prices. You've got a lot of infrastructure going on in that market, and so obviously, off the back of that, there's a lot of activity, and there's a lot of positive consumer sentiment, which is really driving price growth in that market. So hence the reason it's approaching the peak of the market, and we're seeing values go up. As opposed to a market like Melbourne, which is in a declining market. Now, a declining market doesn't necessarily mean that property values are going backwards or declining. It just means a lot of the heat in the market has come out of the market. So essentially, supply and demand is relatively in balance, or if not, the market might be slightly oversupplied. It also means that probably there's more sellers than there are buyers. So there's nothing really driving property growth in that market at this particular stage in the cycle. Interestingly, Victoria is really hurting at the moment in terms of the investor space because it is the most taxed state in Australia for property investors. So hence the reason, we're not seeing a lot of activity driving that market, and therefore, it's on that downward slide. That's essentially the difference between a couple of markets where there's heat in the market and where we're in a declining market. But if we look at over the last 5 years, there's been certain fundamentals that have happened, or certain events that have happened, I should say, that have really changed the historical natural patterns of a property cycle. So essentially the two key ones over the last 5 years, Simon, as you'd know, we had record low interest rates a few years ago where, interest rates, where were they sitting?
Yeah. I mean, like, geez, with the 4-year fixed rates at 198, for example,
Yeah, that's right. I mean, essentially, we were at 100-year low interest rates or something ridiculous like
bottom
that,
of the
whatever
barrel.
it was. Yeah, and we'll probably never see that again. But essentially, artificially, those sorts of things really changed the way the property cycle was. And then over the top of that, we had a health pandemic with COVID, which we've almost hopefully forgotten. But COVID, low interest rates. Interestingly, at the time, I've witnessed something I've never seen in the property cycle before, and that was predominantly most in Australia, most regions were sitting in that rising market part of the cycle in and around 9 o'clock.
Yeah,
and
I was going to say, like, that work from home phenomenon, and obviously now we're leading to hybrid working, has had, and people have changed their sort of, I suppose, their goals and focus during that time as well of where they want to live, and that's had an impact to the interstate migration as well. The different priorities of, why am I living in a big city, in Melbourne with lots of rain when I could live in the Sunshine Coast, and do the same thing.
Yeah, absolutely, and even regional areas. Like you say, people wanting to get out of the city because they weren't really too sure about what the COVID longevity was going to be and how safe it was. So we saw a massive growth cycle in a lot of key regional areas. It's one thing I hate is when we tend to, people talk about property, and particularly mainstream media, they tend to generalize, and I really don't like that because property is what's happening right now in Perth, or is not what's happening in Melbourne, is also not what's happening, in Geelong or Brisbane. Every market's going through a different stage of the cycle, but it was really unique during that time because regional areas, but also major city areas, were going through that rising market. And you remember back in 2020 at the start of the COVID cycle, we had all the major banks coming out and saying property was going to go backwards 20%.
Yeah, all the doom and gloom came out, but didn't happen.
That's right. And what happened in turn? It actually went up about 20% in a lot of these areas. So it was most unusual, but we've returned, I guess, back to some level of normality with cycles, albeit it'll be interesting to see if Mr. Donald Trump has got something to influence in that part as well. So it's interesting times. I think the stability of where we were 10, 15, 20 years ago, I think we're going to see more and more of these fragmented, changing events into a cycle.
And is it, you always hear about people talking about a 7 to 10 year time frame between, I suppose, peak to trough. Is that usual, or is it just that's somewhat irrelevant now with these sort of changes coming in? And
yeah, it's a good question because, I mean, historically in Australia, you could, I think 7 years is, I know a lot of people talk about 7, 8 years, and I've always been a little bit on the conservative edge of that. To me, again, don't like generalising, but I think the property market generally would be moving, most regions would move through a cycle in an 8 to 12 year window.
Yeah.
Again, it depends whether you're talking capital cities versus regional areas and so forth. But it comes down to the microeconomics of an area as well. Right now I said Brisbane's at the top of the cycle. That doesn't necessarily mean it's going to come through to the bottom of the cycle at a very slow pace because we've got this thing called the 2032 Brisbane Olympics, which is only 7 years away. Yeah. So we're going to see Brisbane. Yeah, we're going to see Brisbane come through that weaker part of the cycle pretty quick. So there are sometimes events, whether it's a GFC or a COVID or an exceptionally low interest rate environment or a sporting event like the Olympics, that's going to mean certain markets come through quite quickly, and they won't be 7, 8 to 12 years in getting through a cycle. Whereas, unless we see some change in the thought process of the Victorian government, I can see that the Victorian property cycle going possibly towards the latter end of that 10 to 12 year part of the cycle. So there is, to answer your question, there is no set time frame or set rule. And when we talk, property clock, and we use that as a tool, it's only a guide. Because there are always going to be exceptions to that. But yes, in short, I agree with you. There's going to be a lot of events moving forward, because I think we live in a bit more of an unstable world now. So,
well, I suppose that no matter what happens, it takes time for those changes to feed through, as well. So, these things don't happen instantly. Maybe interest rates is probably the only one that has a very quick impact, because, it increases people's borrowing power, and pretty much, you do the assessment on the Friday and they're on the weekend out there shopping, at a higher price,
Yeah, essentially. And, I think it's really interesting because, we're in a really interesting stage again now with all these tariffs that Trump's brought in. I'd be interested to get your thoughts in a second, but, we're sitting here now. We've had our first interest rate cut just a couple of months ago for the first time in, 18 months. And we're likely to see, everyone's saying with certainty that there'll be another interest rate cut in May. And I'm even hearing some commentary about it potentially being 0.5% instead of 0.25.
There was some commentators talking about an emergency, RBA meeting as well, sort of thing, before the scheduled meeting to sort of maybe cut, like they did, if you remember back in COVID times, they sort of brought it forward to sort of make that immediate sort of change. But I don't know, it'd be interesting times. There's just so much uncertainty out there at the moment. So,
well, I mean, it is interesting because, as you said, the RBA have been, I guess, quite conservative and slow in getting to a point where, obviously, with the inflation being high, they've been quite slow and conservative about giving our first interest rate cut. And now, because of what Trump's done with these tariffs and the global economic world being shook up a little bit, there's a lot of talk around possibly as many as 4 interest rate cuts in the next 12 months. So these are drivers also for what's going to happen in the property market.
I was going to say, so then leading back to the property clock and the property cycles, that's, as we saw with COVID, assuming that unemployment doesn't, go, ballistic sort of thing, then property prices as a whole, if you're looking at, macro level, should increase quite considerably. Would that be your sort of take on it?
Yeah, look, I'm actually quite bullish about what's going to happen in property. I think, typically there are a subset of investors that will swing between the share market and property based on what's been more positive at the time, and obviously we're seeing what these tariffs have had an effect on the share market. So I see some people driving back into the property market. There's some very key markets that are significantly undersupplied, and when we look at our growth of our population forecasts, we're not in a position in several key markets that are going to keep up with the demand of or our needs of what property is required. So as we fall further and further behind, it's the old, supply and demand fundamental. If that is out of kilter, then obviously property prices are going to go up, particularly off the back of if we see, some more interest rate cuts. We essentially, there's going to be a FOMO effect. There's people that have been sitting on the sidelines waiting for a little bit of movement down in interest rates that are all of a sudden going to come quickly into this market, particularly if we see 2 or 3 interest rates over, a few month period.
Yeah.
And then all of a sudden it swings quickly back to a seller's market. But as we see that shift as well, you see then sellers holding out because they know that the market's on the way up. So as they hold out, then stock levels of available properties on the market start to tighten up, which then the FOMO people really drive the prices up because there's less to choose from. So therefore they're paying more for it.
So it sort of creates its own upward spiral,
Absolutely. Yeah, absolutely. So, and I think really, there's, again, I encourage people, it's all about research, it's all about analysis, it's all about understanding what's going on in the market, what the cycles are, and that's what we're trying to share with you. But essentially, again, don't generalize. Don't think everywhere is going to go up in value. Don't think that every property type is going to go up the same. There's a very key difference between units and houses, for example. But there are some really, really promising, really strong property markets coming up where if people do their research, do the analysis, they seek, the right advice, they're going to do very well in this upcoming property cycle.
Yeah, and that was my next question was, when you're at that property clock of either at the top or at the bottom, are they the areas that you're looking for, especially at the bottom, for an opportunity to sort of like, does it pique your interest, I suppose, when you're looking at your research as a starting point, to see if you can get these bargains and see if it, and then obviously research your fundamentals, et cetera, et cetera?
Yeah, good question. I mean, as a property advisor, I'm very cautious around the timing for people and advising people to get in. For me, 6 o'clock being at the bottom of the market is where it starts to come on my radar, of course, but I don't tend to jump in too quickly on that because some markets can get caught up on that bottom of the market cycle for maybe 2 or 3 years. And if somebody's trying to achieve their goals within a 10 or 15 year window, 3 years being in a fairly stagnant market is a significant chunk of someone's window or strategy. So for mine, it's really the real trigger of getting in is probably around the 7 to 8 o'clock mark at the start of a recovery, because once we know that the start of a recovery is happening, generally speaking, it will then, shortly move into 9 o'clock into a rising market, and that's where you're going to get your strong growth. So the real action of upwards price movement is between essentially 7 and 12 o'clock. But we certainly don't want to be coming into the market at sort of 11 or 12. We really want to be coming into that market between 7 and 9. So essentially, depending on where property is at in the cycle, it's really essentially you want to try and get into that property market on the upswing, because that's going to mean you're going to go through some good strong growth in property, which you then might want to leverage that equity out of that growth to then possibly expand your portfolio with another property.
Yeah, so I mean, if you've got a property that's at the top of the cycle, is that just sort of like your time to exit, I suppose, or is there something else to consider?
Yeah, look, it essentially comes down to the individual person's strategy. Whether they're 10, 15, 20 years off retirement or they're less than 5 years off retirement. It comes down to the strategy. Obviously, the best time ideally to sell is when demand is high and supply is low. So essentially at the peak of the cycle. But, that's a real test of timing because there's not an exact day where it comes off the peak of the cycle. So you've really got to, probably not hanging there too long.
Yeah.
And it might be, even if you sell out a month before the market or a few months before the market tops out, it's still going to be a great position for you. But essentially, going back to your question, Simon, it really comes down to the strategy, because in Australia, we've got high entry costs and high exit costs to get in and out of property. Obviously, entry costs are going to be stamp duty, and exit costs are going to be capital gains tax and agents' fees. So, typically you don't want to get into this buy, sell type, unless you've got that risk profile that's going to be able to handle that, and obviously you've got that capacity. But essentially, it can be quite costly to transact in and out of property. So the real wealth in property is through the long-term compounding growth. So you've just got to be prepared to ride out some of the downward swings in a cycle, because property is not as liquid as shares. So, if you're trading in and out of shares, then obviously that can be done a little bit easier.
I suppose those high transaction costs, don't get me wrong, they're a bit of a pain when you're buying and selling sort of thing, but it also stops that volatility that you see in comparison to shares.
Yeah, absolutely. Yeah, absolutely. But another way to sort of work around that is, obviously, if you've got the capacity and you've got the appetite, is we can certainly acquire a small property portfolio. So my view on that is, really, you should have geographical diversification. So when we talk the property clock, if, for example, Brisbane's going through a strong upswing in the cycle and Victoria's going through a downswing, that's going to change at some stage. Victoria will come up and Brisbane will come down. So if you've got your strategy right and you've got the ability to do it, then ideally, if you've got a property in Brisbane, a property in Melbourne, and possibly a property in Sydney and a property in Perth, at any given stage, one of those markets should be going up in the growth cycles. So it means that your portfolio is still moving forward at any given stage if you've got that geographical diversification. One of the big mistakes probably is to hold multiple properties in the one backyard or market, because you essentially are putting all your eggs in one basket. And if you go through a soft part of the cycle, you're sitting idle as an investor, and it's not an ideal position to be in.
Yeah, and I was going to say, you've got land tax issues as well, which can crop up, which if you're
absolutely
in different states, you wouldn't have that issue. And then that sort of leads into your loan structuring as well. I mean, that's for another day, but, your loan structuring should sort of have that diversification with lenders. So, that you've got those ability then to take advantage of those rising, property values and not have any clawbacks on sale proceeds and things like that with loans being restructured. But again, that's another day, discussion, but just quickly into there. Yeah, we get there. So.
We'll cover that off. But look, essentially, I think that's a really good introductory start to, where the property clock and the property cycles are at. Essentially right now, we're in April of 2025. If I look around the key markets around the country, right now, Brisbane would be approaching the peak of the market. Not quite there, but approaching the peak of the market. But I don't expect it to go into a long downturn, because we've got so much infrastructure, so much excitement, so much population movement, job creation, on top of a housing shortage in that market, all building up to the Olympics. It's going to be shortly coming back into a rising market again. So that's an interesting market. Sydney is starting to decline. It's interesting because when we see some interest rate cuts, it might possibly slow that decline down and possibly move it through quite quickly. Melbourne's in that declining market, like I said. Really, one of the bigger markets, a bigger city of Victoria outside of Melbourne is Geelong. That's at the bottom of the cycle. But then we've got going into that growth cycle in that 7 o'clock. We got Newcastle in New South Wales, the Central Coast of New South Wales, Canberra, the ACT. So there's plenty of movement around, but one really good market at the moment that's in a rising market. There's a significant housing shortage. There's a rental crisis. There's population movement, job growth, and a lot of positive things going on is Perth. So Perth sitting right there around 9 o'clock. Plenty of life left in that market. So really interesting time. Similarly with Adelaide, slightly different story, but Adelaide's in that rising market phase as well. So essentially they're the bigger regions, the bigger capital cities around the country where they're at now. So Simon, talk to me about lending. Give me an update on what's going on in the world of lending and the banks.
The exciting world of lending. So I know we've spoken about interest rates, how that influences property values, but the recent announcement was how the government's been speaking to APRA, which is the banking regulator, on how HEX is dealt with. Now, just a quick reminder what HEX is. They keep changing the names. There's HEX, Help, Study and Training Loans. I'll just refer to it as HEX because that's what I know it as. So where you go to a uni or a education course provider, the government pays for that course. You get a loan via the government and you essentially pay that back once you earn over a certain threshold, and the repayment is based on how much you earn. So it's a bit different to a normal loan where it's not looking at a term, the rate or anything like that. So at the moment, once your income is over 54,000, that's when it starts kicking in. It's going to be increased to about 67, and so you pay it back, sort of thing. So what the government's been working with the regulator is to actually exclude the HEX repayments when it's close to being finalised. So they're talking, 1 to 5 years that the loan would be, extinguished, sort of thing, which has a very big impact to capacity, to your serviceability and your maximum borrowing ability. So I did some quick numbers on a real couple that we'd worked with, I think about 6-12 months ago. They both had small HEX debts. One was on 90K, one was on about 140K, and their borrowing capacity went from 651K to 932,000, with this change sort of thing. Yeah, so it's just over 280,000, so it'll have a very big impact to those clients which are, in that about the 100K plus range, because obviously the repayment, the HEX repayment is tiered, gets higher and higher as the more you earn. And so it'll have a very big impact. Now, I know to date, the only lender that's come out with specific guidelines is CBA, but no doubt the rest will follow. So I think, this will have a really big impact, to clients' sort of ability to increase their borrowing power.
Yeah, I mean that's significant. That's the difference between somebody getting into a property or not.
Yeah, it's huge. Like as I said, with that couple, real world example, 280K. That's massive difference. Sometimes when we're doing assessments and stuff, we just need that little nudge. Nothing compared to that. So I think it's going to have a huge impact to people in those positions, which will be great.
Putting further pressure on the property market and property prices going up.
I won't get into have they won the war or anything like that, but it's definitely, let's say, won the battle. Whether I think it's a good thing or bad thing or whatever, it's not up to me. All I'm looking at is the client and, what are they trying to achieve and can I get that over the line? So,
yeah. No, look, it's important. And one thing we're trying to do with this podcast moving forward is we're obviously talking property, but lending is such an important ingredient to that. It's the oxygen to anyone doing something in property. And what a lot of people don't realise is they treat the lending space as a transaction. It's just a bank and it's just a loan. But, our experience over Simon, the last 20 odd years suggests there's as much strategy in the lending space as there is in the actual property space itself.
Yeah, 100%. I mean, I'm always looking at the big picture, as well as, because I think it's more important to be able to get that investment property to keep powering yourself forward rather than focusing on the smaller details. And we've seen that with, I think 2016, remember the interest-only loans being capped, investment loans being capped, and you just had to, box clever to keep your strategy moving, and take advantage of those opportunities which came up, which no doubt, even though that those were some headwinds on the finance space, there was still some good opportunities out there. And you just needed to, look at alternative financing options during those tougher times.
Yeah, absolutely. Absolutely. So is there anything else happening in the lending world?
No, the only I think quick one was the Westpac and NAB announced that they're now doing multiple offsets. It's becoming quite a common thing. Just a rehash on what an offset account is just it's like a separate everyday bank account with a link behind the scenes to the loan. And when the loan repayment for the interest calculation is taken, it's taken at about the loan amount minus whatever's in the offset account. So with the great thing about multiple offsets is everyone runs their own finances differently, but as a general approach, most people have like a savings offset account, an everyday offset account, and a bills offset account. The great thing about that is it's easier to budget and manage and see where you're at rather than having it just in one container, I suppose. And but all three of those will then combine to then offset the mortgage, so it's great. And I'd say that other banks will then follow. There's quite a few already that do it, for example, Bank West and St. George and stuff like that. But it's great to see those guys, coming sort of, I suppose what I'm trying to say is becoming a bit of a standard now rather than just having one offset per loan, which is the old school way of doing it.
Yeah, it's gives it a bit more flexibility, which makes it more appealing to a larger number of people. So I think it's a positive thing.
Yeah, no, it's great. So exciting.
Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any decisions. Please see the link at the bottom of each episode.